Hi guys, very good morning. Rajesh, this side Rajesh from RD Education Services. In this presentation, I'm going to discuss about banking relationship, and along with that, what is credit management system and what kind of treasury policy a corporate can adopt. So let's start with the banking relationship. Company needs a small number of relationship banks from whom it can purchase its treasury products. The products that these banks offer needs to be strongly differentiated between the individual banks that offer them. Some banks, for instance, have specialization in certain derivative products that meet the company's particular needs. The essence of good banking relationship is for the company to exploit the favored products market position of the banks to both the companies and banks' mutual benefit. A company probably needs at least one bank in any territory where it has more major operations. This bank will need to be able to offer the administration of the current account, short-term credit facilities, and efficient international payment. There is no rule for a number of the banking relationship. Many treasury teams believe that there is no point in establishing relationship with the investment banks. Should major acquisition or disposal be affected, the advice will come from the company's merchant banks, where the officials are close to the company's senior executives. This is probably true, but today most banks that have advisory arms to their business are also part of large banking group. In these circumstances, the company should be able to leverage the existing relationship to access the products that interest and concern it. Relationships are never stable. Wrongly or rightly, bank usually achieves the status of a relationship banks by participating in one of the company's major bank financing. This financing for most company is a revolving credit that provides the company's core finance to meet the working capital and small acquisition needs. Banks are continually changing the perception of their desire to be involved in such financing. In addition, they are continuously comparing the return from the total business generated by the relationship with the cost of capital required for support it. If banks consider the returns are inadequate, they will reduce support to the company. So let's now discuss about what is cost of capital. Cost of capital is a minimum rate of return that business must earn before generating value. Before a business can turn a profit, it must at least generate sufficient income to cover the cost of the capital it uses to fund its operation. This consists of both the cost of debt and cost of equity used for financing a business. A company's cost of capital depends to a large extent on the type of financing the company chooses to rely on. Its capital structure. The company may rely either solely on equity or solely on debt, or use a combination of two. Choice of financing makes the cost of capital a crucial variable for every company, as it will determine the company's capital structure. Companies look for an optimal mix of financing that provide adequate funding and minimize the cost of capital. In addition, investors use the cost of capital as one of the financial metrics they consider in evaluating company as potential investment. The cost of capital figure is also important because it is used as a discount rate for companies' free cash flow in the DCF analysis model. As a result of this, a treasury needs to be continually open to the new potential relationship and ever sensitive to which the existing relationship may deteriorate. Most banks that participate in a major financing maintain that returns from the traditional bank lendings are insufficient to cover the cost of capital required to support their commitment. As a result, they are continually looking for an ancillary business from a company to subsidize the bank lending activities. This is a real problem for many treasurers, as since many companies do not have that volume of ancillary business. Unfortunately, there is no much that can be done other than to extra sensitive to ensuring that all treasury business goes to relationship banks. Additionally, treasury needs to be ensured that relations banks have wherever possible an opportunity to bid for all relevant treasury business. What each side must give the relationship, most treasurers would probably see the key elements to a successful relationship as being product compatibility, personal chemistry, integrity, the ability to see each other's point of view, open information and understanding, credit standing by the banks, and credit consciousness of the company. Now, I'm going to discuss about credit management. Credit management group within the Treasury Department is responsible for implementing and ensuring compliance with credit policy established by the organization for the management of derivative credit exposure. Through strategic, tactical, and risk-oriented teams of professionals, Treasury Credit delivers the highest quality services and expertise to its stakeholders. The most crucial part of credit management is to manage the credit risk. Most of the institutions have faced difficulties over the years for a multitude of the reasons. The major cause of the serious problem continues to be directly related to tax credit standards for borrowers and counterpart. Poor portfolio risk management or a lack of attention to change in economic or other circumstances that can lead to a deterioration in the credit standing of an organization counterparties. Credit risk is most simply defined as a potential that a borrower or counterparty will fail to meet its obligation in accordance with the agreed terms. The goal of credit risk management is to maximize organization risk adjustment rate of return by maintaining credit risk exposure within the acceptable parameters. Organization need to manage the credit risk inherent in the entire portfolio as well as the risk in individual credit or transactions. Organization should also consider the relationship between the credit risk and other risks. The effective management of the credit risk is a critical component of comprehensive approach to risk management and essential to the long-term success of the organization. For most organizations, debtors are the largest and most obvious source of credit risk. Now I'm going to discuss about investment policy or treasury policy of any corporate. So let's start. Manual people should behave rationally, especially when it comes to finance. They often do not. One of the big way to prevent this from happening in your investment portfolio is writing, implementing and abiding by the something known as investment policy manner. In essence, it is a set of ground rule and guidelines about how to specific pool of the asset will be managed. It details the parameters under which a portfolio will be established, managed, tracked and protected. It can range from a very simple 5-page document, which is probably all we need. A comprehensive investment or treasury policy manual ideally covers the following area. First one is purpose. The investment policy document of organization sets forth policy and procedures to guide day-to-day administration of the all investment activities. Second is responsibility. The board of directors is responsible for the formulation and implementation of investment policy. The board may delegate its decision-making authority with respect to specific investment to the president for implementing investment policies and consistent with its policy document. The board may also appoint a investment committee to act as liaison between the board and management. The main function of committee will be working with the management or investment issue and problems, monitoring and reviewing for investments in the financial institutions, monitor investment decision for compliance with the policy documents, and review the policy document and recommend changes to the board when appropriate. Now talk about investment objective. The investment policy document will enumerate the finance and investment objective of the organization in detail and boundaries within which investment can be made by the treasurer. Portfolio composition. In the light of the investment objective, the policy document should be prescribe the portfolio composition. For example, the portfolio should be comprised of the security within the following characteristics, which includes your low degree of default risk, low degree of interest risk resulting from the change in the level of interest rate, then high degree of liquidity. The policy document may further contain the guidelines related to authorization. What kind type authorization? While I'm talking about, it includes your types of investments, maturity of investment, whether it's a short-term or long-term maturity, the diversification requirements, risk management policy. All the organization aim to run risk-free operations. However, the truth is that no matter how careful they are, there is always a danger of exposure to unexpected and unplanned for threats. Implementing a risk management policy throughout an organization is the best way of identifying and managing these threats before they become costly problems. Embedding such a policy within daily operation also help with making well-informed choices, as decision makers better understand and evaluate the wider impact their actions which they have. A good risk management policy builds a sound framework of risk assessments and identification, risk ranking, action plan, assessments and review, then compliance and feedback and improvement. So far we have considering risk management from the standpoint of the corporate treasurer, and the concept of financial risk that was used was that which the treasury has responsibility for managing. In 90s, the idea of managing risks throughout the organization was relatively new, and most companies focused on the specific, mainly financial and insurable risk. Companies have come to pay particular attention to the management of risk through their organization due to the combination of legal compliance requirement on the companies, the increasing need to communicate a company's risk management process to various stakeholders, and a recognition of the benefit that an active and corporate wide risk management program can have in achieving the strategic aim of organization and building shareholder value or stakeholder value. An investment and assessment of the system of internal control is relevant for the smaller listed company as it is for the larger ones. Since the risk facing such companies are generally increasing, risk management is essential for reducing the probability that corporate objective will be jeopardized by unforeseen investments or events. It involves proactively managing these risk exposure that can affect the everything the company is trying to achieve. Among the steps involved implementing and maintaining an effective risk management systems are identifying risk, ranking those risks, agreeing control strategy and risk management policy, taking action, regular monitoring, regular reporting and review of the risk and control. As can be seen, the process of maintaining risk on an enterprise-wide basis is essential the same as the established by the Treasury for the managing Treasury-related financial risk. Now let's discuss about conclusion remarks. Cash managers are subcategory of the corporate treasury personnel who focus on the balancing incoming payments from the customers with outgoing payments to suppliers and for taxes. Cash managers also seek appropriate investment opportunity for excess cash, normally in short-term debt or bank deposits, giving the field and aspects of money management. Additionally, corporate treasury also involves monitoring and forecasting the company's need for outside funding, both long-term and short-term, utilizing bank loans, commercial paper, bonds issue, stock issues to meet these needs for cash. Corporate treasury personnel work in close concert with outside investment bankers. So, thank you very much for listening so patiently.